In this video we are going to talk about 15 dividend kings. So before starting, please like this video and subscribe to this channel for our future updates. Dividend Kings has a proven track record that provides a layer of security in an otherwise volatile market. These 15 equities have a track record that suggests they'll be more reliable than your usual income investment in 2021. Number 15. Dover. The industrial group was founded in 1955 and develops hydraulic pumps, refrigeration equipment, and oil and fuel products. The firm is stable and has enabled this dividend king to increase payouts for 65 years in a row. Last year's growth was only half a cent, or around 1%, due to coronavirus interruptions. They recently surpassed early 2020 highs, indicating the industry is stabilizing and may be prepared for stronger growth in 2021. Number 14. Genuine Parts. Genuine Parts, GPC, $105.35, is a major auto parts supplier in the US. But it sells replacement parts in places like Canada, Europe, and Australia. It also sells parts for buses, motorbikes, farm equipment, boats, and industrial machinery used in forestry, mining, and other industries. GPC began in 1928 with the purchase of a small auto parts company in Atlanta, and now has 3,600 locations in 14 countries. Genuine Parts has a long history as a firm and as a dividend payer. It has increased dividends for 65 consecutive years, tying it with the dividend kings for the longest stretch. GPC's most recent upgrade was 3.2% for the April payout. Number 13. Procter & Gamble. It's been called a widows and orphans stock since it's expected to be around and provide for your family even if you die. Despite strong brands like Gillette razors, Pampers diapers, Charmin toilet paper, and Tide detergents, P&G has faced some short-term challenges. Due to the pandemic, some people have cut back on grooming goods and are living in sweats. This is hardly a reason to avoid this tried-and-true dividend king that has increased its dividend for 64 years in a row. Especially now that immunizations are on schedule and the world is slowly returning to normal. Number 12. Emerson Electric. Emerson Electric, EMR, $85.90, is appealing since it is a firm with several hats. The company designs technology and engineering products for a variety of industries, including oil and gas, programmable thermostats, furnace ignition systems, food and beverage valves, and sensors. Its life sciences area has recently attracted a lot of attention because EMR is part of the pharmaceutical cold chain that keeps sensitive drugs like the COVID-19 vaccination at the proper temperature. Number 11. 3M. 3M, $175.06, invents adhesives, sheets, filters, and lab supplies. Investors should look beyond its N95 masks to its Post-it notes, Scotch-Brite sponges, and Command adhesives and fasteners. 3M's $100 billion market cap and excellent partnerships with many industries make the total more than the parts. It also encourages rising dividends. Decay's flaws affect too. In 2018, earnings problems reduced the stock price by 20%. A 1% rise to $1.48 per share in 2021 is the company's only dividend hike. Number 10. Cincinnati Financial. Considering how volatile US banking stocks have been over the last 3 decades, it's no small feat that Cincinnati Financial, CINF, $97.87, has not only avoided lowering dividends, but has actually increased them. Sure, Cincinnati Financial specializes in personal life insurance and annuities. When you consider that Allstate, cut its payouts in half after the 2008 financial crisis, it's hard to suggest that CINF just got lucky not being engaged in mortgages. While frequent premium payments from consumers make insurance a solid business, CINF is exceptionally well run. Number 9. Coca-Cola. After the Black Monday debacle, Warren Buffett bought Coca-Cola, KO, $49.99. Buffett and Company are heavy on dividends, and few deliver better than Coke. For nearly a century, Coca-Cola has paid dividends. For 59 years, it has increased dividends. The latest increase was 2.4% to 41 cents per share. Among its beverage brands are Coca-Cola, Minute Maid juices, and Powerade sports drinks. It recently announced that its US bottling factory will use 100% recyclable materials. Number 8. Johnson & Johnson. Johnson & Johnson, J&J, $158.46 is the gold standard of low-risk income stocks. J&J has a market capitalization of more than $400 billion, ranking it among the top 20 U.S. equities, and generates more than $90 billion in revenue per year. Its dividend yield of 2.6% is higher than the current average S&P 500 stock yield of around 1.6%. It has also increased dividends for nearly 60 years in a row, comfortably qualifying it as a dividend king. With the recent FDA emergency use approval of J&J's COVID-19 vaccine, it's no surprise that the stock recently hit fresh all-time highs. Number 7. Lowe's. Lowe's, low, $159.75, is a cheaper alternative, HD. Given that it now offers a greater dividend yield, it is worth more than double. However, in the last year, Lowe's stock outpaced Home Depot by 52% to 21%. Also, Lowe's has increased dividends for nearly 60 years. Its most recent quarterly increase, from 55 cents to 60 cents a share, began in October. This follows a 15% gain last year. While many investors may favor larger competitors, Lowe's makes a strong case for income investors now. It's also a great time to check out this dividend king, because the home remodeling boom should last until at least mid-2021. Number 6. Colgate-Palmolive. Colgate-Palmolive, CL, $75.20, has long been a low-risk portfolio benchmark. People will buy toothpaste and cleaning goods regardless of the economy or quarantine. A multinational brand, Colgate is a dividend king. Think about how much of the global market for manual toothbrushes and toothpaste the company claimed at the start of the year. Oncology predicts considerable delays, including currency fluctuations and difficult year-over-year comparability. As a result, expect a slight increase. A fast-growing dental care brand, Filorga, was acquired for $1.7 billion in 2019. Hello, CL is likely to be a long-term winner. Number 5. Hormel. Its products range from branded chili and pepperoni to Dinty Moore stews, House of Sang sauces, Skippy peanut butter, and many others that you may already have in your pantry. On the contrary, according to business literature, more than 40 of the parent firm's brands are no. The Dividend King announced a 5% dividend raise in November, marking its 55th straight year of dividend increases. Hormel has been paying dividends since 1928, when it became a publicly traded business. Hormel will remain a mainstay in American kitchens and dividend portfolios for many years to come, thanks to its recent $3.4 billion acquisition of nut giant Planters. Number 4. Stanley Black & Decker. S&D, SWK, $174.84, carries items from DeWalt, Craftsman, Mac, and other well-known hardware store brands. It also contains high-end tools and supplies. SWK engineered fasteners are said to be in 90% of new cars and light trucks sold in North America and Europe. Given that many businesses would collapse without these products and technologies, Stanley is a safe bet. While the corporation has a rich history of mergers and acquisitions, its dividend history dates back to Stanley's bolt manufactory. That makes it a dividend king. Number 3. Federal Realty Investment Trust. Federal Realty Investment Trust, FRT, $101.17, is a real estate investment trust, REIT. This classification benefits capital-intensive businesses that buy real estate. These companies must refund 90% of taxable income to shareholders. As a result, income investors adore REITs. Its long-term stability sets it apart from other commercial real estate firms with bigger dividends or larger market caps. The epidemic has harmed FRT's mixed-use and retail assets. Aside from the long-term contracts that provide steady revenue, the Dividend King can rely on its tenants. Number 2. Cisco. Cisco, SYY, $79.63, supplies food to schools, hospitals, and restaurants. SYY's stock price has nearly doubled from last year's lows and is back to pre-pandemic levels. Everything is priced in. Since early February, when the company reported an 82% drop in second quarter profits, shares have risen roughly 9%. Due to recent acquisitions and massive scale, SYY will regain dominance when public eating returns. Cisco hasn't increased its quarterly dividend since November 2019, when it increased it by 15.4% to 45 cents per share. If there is no increase in dividend payout by 2021, Cisco will be removed from the list of dividend kings. Number 1. Illinois Tool Works. Illinois Tool Works, ITU, $202.18, a century-old manufacturing company, is not as well known as other stocks on this list. Some ITU clients may not be aware of ITU's substantial operations in the automotive, construction, and food service industries. This $63 billion industrial behemoth has many niche markets where few other companies can compete. A long-term investment in Illinois Tool Works. Over the last 5 years, the stock has beaten the S&P 500 by 24% while delivering dividends to shareholders. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.